In the last couple of weeks, I have seen a lot of discussion amongst retail investors around two small cap high growth companies, and that is IREN and Zeta. So in today's video, we're going to take a look at both of these companies. We're going to go over what exactly they do. We're going to go over their most recent earnings announcement, some of the metrics behind the company, and then I'm going to give my opinion on which of these two companies that I think has a stronger growth potential sitting in front of them. And we're going to start off by going over IREN. IREN goes by the ticker symbol IREN, and today alone the stock moved up by almost 10%. Year to date, this stock is up by almost 63%. However, it appears that the best time to actually be buying it in the last year or so was just a few months ago when the stock hit around $5.50. If we look at the last 5 years, this company IPO'd when IPOs were extremely hot. That was back in 2021, and it IPO'd for a price of around $25 per share. However, from that time until really the start of 2023, the stock traded down in a major way, down to around $1.25. However, from that time till now, it has traded up very nicely and is up over 1,200%. Normally, when I come on companies' websites, I try and look for some promotional video that kind of gives an outline of what exactly the company does. IREN has their own video, but honestly, it hardly spells out what the company's main mission focus is. I think the best way of actually looking at what the company does is really this couple sentence blurb down here. So we own and operate next generation data centers powered by 100% renewable energy. Our facilities are optimized for Bitcoin mining, AI cloud services, and other power dense compute. Fundamentally, what IREN is doing is not anything that is brand new. They're focused on renewable energy to power their data centers. The thing is that this has been something that has been going on for a number of years. Bitcoin miners have looked at renewable energy to try and drive their energy costs down to increase their profit margins. And that is basically what IREN is doing. And right now, the company has 4 facilities. Canal Flats, Mackenzie, and Prince George are all located in Canada, and Childress is actually located in the United States in Texas. And right now, the company is executing on plans to expand their Childress location. They're adding an additional location at this site called Horizon 1. On top of that, they're also looking to add a Sweetwater 1 and a Sweetwater 2 facility, which are going to be located in Texas as well. And right now, it sounds like Horizon 1 is planned to be completed sometime in 2025, with Sweetwater coming online in 2026 and then Sweetwater 2 coming online in 2027. Here's the big red flag for me when it comes to IREN. If you look at their total revenue, last quarter they brought in $148.1 million. However, the majority of that revenue is coming from Bitcoin mining. Bitcoin mining resulted in $141.2 million of revenue, with AI cloud services only providing $3.6 million of revenue. So that means that currently the company has 95% of their revenue coming from Bitcoin. They are doing a great job of managing their costs. It's only costing them around $41,000 to produce one Bitcoin. So that provides a healthy profit margin based off the current price for Bitcoin. As of recording this video, Bitcoin is trading at a price of around $110,000 per coin. However, if we go back less than a year ago, we can see that Bitcoin has traded for around $55,000. That would be a significantly lower profit margin than the current price that they are getting on their Bitcoin. And if we go back 5 years ago, we can see that over the last 5 years, there have been plenty of time periods where Bitcoin has traded at values less than $41,000. And we have also seen major drops in the price of Bitcoin. At one point from 2021 until 2022, Bitcoin dropped by over 70%. If we were to see a drop of 50, 60, or 70% in Bitcoin, that would clearly take the price well below the $41,000 mark. But honestly, if you are looking to purchase or even have purchased IREN stock, what you are likely betting on is a transition taking place for this company. The management team is clearly looking to diversify their business. In their most recent earnings report, they said we are now pausing further mining expansion to focus on scaling our AI infrastructure initiatives. This shift in strategy will help the business diversify away from being so reliant on Bitcoin prices. But also, this is a faster growing segment of the company. They grew 33%, and that is not year over year growth, that is quarter over quarter growth. They brought in $2.7 million in Q2 of 2025, and they increased that to $3.6 million in Q3 of 2025. These are small numbers, so it's a little bit easier to grow them at a faster pace. However, we could continue to see this growth rate accelerate over the coming years. And that's what these new data centers are primarily going to be focused on. Horizon 1, Sweetwater 1, and Sweetwater 2. All of these are focused on expanding their AI business, whether it's AI training or even inference. So in my opinion right now, looking at IREN's metrics can be a little bit deceiving because if you look at the revenue last year, they were bringing in around $53 million. If you look at this year's revenue, it's coming in at $141 million. A lot of that is price appreciation of Bitcoin. It's up around 80 to 100% over that time period. That has obviously boosted their revenue in a major way. However, the second thing is they have also expanded their mining capabilities. So those two things have accounted for this massive increase in revenue. But if you're investing in IREN or looking at this company for the future, what you are really betting on is their AI business. And right now, they're predicting that they can grow their AI business over the next year to around $28 million of revenue. And this would be a huge step for the business. This would 7x their AI revenue. It would increase their total revenue, assuming Bitcoin mining would stay around the same in terms of $141-ish million. That would bring their total revenue to around $170 million, and it would also increase their percentage of AI revenue to around 16% of the total revenue for the business. The problem with companies like IREN that are very dependent on the price of Bitcoin is it's very difficult to actually value these companies. We can see that over the last year, IREN has had a forward P ratio anywhere between a 3.74 and 125. This is obviously huge fluctuations for a forward PE ratio. And that again just comes back to how difficult it is to value a company because of the volatility surrounding Bitcoin. So if we see IREN actually diversify away from Bitcoin into more AI revenue, that should be good overall for the business and help get them a more consistent valuation. And this is also reflected in their EPS estimates. For 2026, we see a wide range of estimates. There are only two analysts covering the stock, and right now they have EPS estimates of $1.19 and $1.91. That means that the average comes out to $1.55 overall. I honestly don't know if this is even realistic because right now they put up only 6 cents of EPS in 2024, and analysts are only expecting 28 cents of EPS in 2025. So this would be a huge jump in 2026 for them to even get to this lower estimate of $1.19. So for me personally, I have never been a buyer of Bitcoin. I haven't really been interested in it. I like buying businesses because it's very clear what a business provides. Bitcoin to me is kind of like buying gold. I just don't see the value in it. So I right now am not very interested in IREN. However, if they do transition their kind of strategy to actually being focused on AI and providing more data center resources, I think that that could actually propel the business in a major way over the next 5 to 10 years. I actually like this next company much better, and that is Zeta Group Holdings, ticker symbol ZETA. Over the last 6 months, it's down around 15%. However, from April till now, the stock is up around 42%. It does have a market cap of around $3.65 billion, so there's plenty of room for this company to continue to grow, especially in the space that they occupy. And that's because Zeta occupies the marketing space. They are an AI-powered cloud marketing platform that basically allows users to condense a lot of data and information into one dashboard. And in my opinion, this is an absolutely massive market because every company company needs to market to some degree to increase customer count. And what that ends up leading to is a number of different campaigns across a number of different platforms. You need to be marketing on Google, you need to be marketing on Facebook, Instagram, and all of the other social media platforms to really reach your customers. And that's where Zeta can come in and actually manage all of those different marketing campaigns across all of these different sites and give you insight to how you're actually acquiring your customers so you can make more data-driven decisions. And the need for what they are offering is clearly reflected in their numbers as well. They delivered revenue in their most recent quarter of $264 million, which was an increase of 36% year over year. They're also consistently growing their customer count. They are up to around 548 total customers, which is up 19% year over year. And it's not like these are small customers either. They are trusted by 44% of Fortune 100 companies, and you could see some of the brands that they work with: Bloomberg, CNBC, TJ Maxx, TaxAct. There are a number of very large customers that they are actually working with and are actually using their platform already. The biggest problem facing this company is one that is very common to younger companies. They had a GAAP net loss of $22 million. However, the majority of that is coming from the fact that they are offering $42 million of stock-based compensation to their employees. If they were to correct that and obviously cut that even in half, they would go to a GAAP net loss of basically $0. If they had no stock-based compensation, which is probably unrealistic, then they would jump all the way to a GAAP net profit of around $20 million. But even with that, we are seeing the company trend in the right direction. Last year, they lost around 23 cents per share. However, this year, they only lost 10 cents per share. So they are trending in the right direction towards becoming a GAAP profitable company. And in my opinion, in the next 1 to 2 years, I think this company should hit profitability, especially because right now they are growing at such a fast pace. Again, 36% top line growth year over year. Right now, analysts are only expecting 23% top line growth in 2025 and then 17% top line growth in 2026. In my opinion, these numbers are extremely low. I would not be surprised if this company grows by 30+% in 2025 and then probably 25 to 30% in 2026. If you think about what they are offering, again, this is something that every company needs, and this is not going away. The demand for their products are only increasing over time. And obviously, if we see very strong top line growth, 25 to 30% over the next couple of years, I would expect to see similar results on their bottom line. For the current year of 2025, analysts are only expecting non-GAAP EPS of 65 cents. However, next year, they're expecting around 30% growth to 83 cents of non-GAAP EPS. Again, just keep in mind that these are non-GAAP EPS numbers. What we were talking about earlier was GAAP EPS. And right now, the valuation metrics for this company are fairly interesting. The forward P ratio is sitting at a 24.27. This is actually decently low for a company growing as fast as they are. We've also seen them over the past year trade all the way up to a 47 forward PE ratio. So right now, the company compared to the broader market seems to be trading at a discount, and even compared to itself is trading at a discount, as well as their PEG ratio is currently sitting below 1 at a 0.81. So right now, I don't own either of these companies in any of my portfolios, but out of these two, the one that I am more likely to buy is Zeta. Zeta, I think, offers a lot more upside potential due to their valuation, their business model, and how fast they are growing. But what I would likely do is add a small watcher position to kind of pay closer attention to this company. This is the YouTube portfolio, and it's currently sitting at a value of just over $69,000. And right now in this portfolio, I hold Google, Supermicro Computer, AMD, Microsoft, Adobe, SoFi, Shopify, PayPal, Abercrombie and Fitch, Alibaba, United Health Group, United States Lime and Mineral, Estee Lauder, and Hawkins. If you're a long-term follower of the channel, you will notice that I did end up getting rid of my Apple shares as well as my Palantir shares. I am fine with kind of those decisions. If the stocks keep going up, that is great. However, for me, I kind of got the gains that I was looking for out of those companies, and I'd like to kind of build some new positions. Apple was such a small position in this overall portfolio. I only had like 4 shares of the company. So at the end of the day, I decided it was time to kind of just sell out. And then Palantir, I only had 10 shares. So at the end of the day, if the stock goes up, another 50%, it really wouldn't make a huge difference on the portfolio as a whole. It needed to be a much larger position. And at the current share price for Palantir, I just couldn't see myself adding more to that position. But with all that said, let me know down in the comment section, what are your thoughts on the 2 companies that we talked about today, IREN and Zeta? Where do you think they are going to be trading a year from now? And I'm very interested in your thoughts on IREN. Do you think they are going to successfully make this transition into AI data centers? And how do you think that will affect their business over the next 1 to 2 years? I'm very interested in your guys' thoughts. Again, don't buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. With that said, thank you guys so much for watching. If you did enjoy the video, go down below, drop a like, and subscribe for more videos like this one. And as always, have a wonderful rest of your day.